What up, YouTube fam? Today we're talking about using stop losses in your trading. So stick around. Don't skip the video and go and do something else. If you're a trader, this is a very, very important message to you. So stick around and I'm going to give you some pointers that you can use. And also, why is it so challenging to stick to your stop losses once you set them? So first of all, what is a stop loss? A stop loss is a level at which you exit your trade and you decide enough is enough. So let's just say you're buying a financial instrument and the price arbitrarily is at 50 and you set a stop loss at an arbitrary price of 30. What that means is that if the price comes lower and it hits that 30 level, you're going to be out. So in the industry, a lot of people talk about this, and for good reason. So now we know what a stop loss is. It's an order that a trader places into the market to get them out of a position that isn't working for them. And so what is the logic behind a stop loss? Well, think about it this way. The markets are an endless stream of opportunities, and they also present traders with risk. Markets do not care about me or you. The markets are just the markets. They flow and they react to different things, and as I said, it just doesn't care about you as an individual person. It's got no emotion towards you, no feelings or anything. So the logical part of it is that you have to understand that the market can do absolutely anything. And so the way that traders can protect themselves is by setting these stop losses in the trade. So if you think back to that example that we just spoke about, when you do that, you stop yourself from losing a lot of money very, very quickly. And I've been around for a long time and I've seen how markets move. And sometimes they can move really, really quickly. And without a stop loss, you're going to be toast. You're not going to even have enough capital to come back the next day to trade with. Not to mention the psychological damage that it's going to do if you don't cut your losses quickly. Put it this way, imagine you have a £10,000 account or a £100,000 account. Doesn't really matter. The principle is the same. The market can take all of your money and you don't have to actually do anything. You can close the platform, you can close your computer, you can go on a holiday, and the market can take all of your money and more if you don't have a stop loss. It's not like gambling games where a participant is gambling. It's different, and I'm going to explain that. When, for example, someone goes to a casino and plays a game of roulette, they have to put their chips on the table on each round. Okay? That's the structure of the game, and that is the way that it is built as default by the casinos. So for example, a player goes and wagers, $100 on red. And then the ball rolls and rolls and rolls. And at the end of that game, the player either has a win or a loss, but for the next round, they are forced to go into their pocket and put more chips onto the table if they want to play. Yeah? Trading is different. In trading, you don't have to do that. In trading, you can become what's called a passive loser, where you just have your money there, and then what ends up happening, the market goes in a direction that it's not in your favor, and you end up losing inordinate amounts of money. And it's a very, very dangerous position to be in, guys and girls. If you don't have protection in the market, if you don't have a stop loss, you're playing with fire. Again, I'm not a financial advisor, so you have to make your own decisions. I'm just talking about it from a theoretical standpoint. Yeah, based on my experience. By having a stop loss, what you're saying to yourself is that if the trade comes to your level, as an example, that 30 level, you cut the trade, you come out with a small manageable loss, for example, £200, something like that. Not having a stop loss, your losses could be catastrophic, in the thousands and thousands of pounds, until you end up blowing the account. And blowing account means it goes to zero. It's just a trading lingo, okay, that the industry uses when they use the word blowing account. But also for psychological reasons. Psychologically, it is very, very important that you know at what point are you going to stop out of this position, crystallize the loss, so that you can move on to the next position. Because as we said, the markets are infinite. Anything can happen at any time. And it's one thing to talk about it on camera. It's a whole other thing if you're actually experiencing open drawdown in a position, you're losing money quickly, and you don't have a stop loss. Now, another interesting thing is just because you have a stop loss does not mean that you have accepted the risk of the trade. And so that may be a bit of a baffling thing. You're thinking, what? How can that be? If I have a stop loss in the market, surely I accept the risk of the position. Otherwise, what would be the case? What would be happening? Or you say that, okay, I've put a stop loss in the market, that means I'm a risk taker. And from a logical standpoint, it makes sense, yeah, but it couldn't be further from the truth. You see, once you put a stop loss in the market, especially if you're a retail trader and you're at home, no one is watching you. No one's watching over your shoulder to see what you're doing. If you're managing your own money, that's up to you. No one's going to tap you on the back and say, what are you doing there? Okay? Especially if you're a retail trader. So just because you've put a stop loss in the market does not mean you've universally accepted the emotional risk of that trade. So traders will place these stop loss orders in the market, and then when price, for example, is coming close to that, especially inexperienced traders will remove their stop losses or adjust their stop losses to give it more room. And therein lies the problem. So let's say in our example, the guy has got a stop loss at 30, and then the price is coming down, 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 close to hitting 30. Once it hits that level, it's going to crystallize the loss. He's going to crystallize the loss. So the trader doesn't want to do that, and in a split second moves that stop loss to 10. Now let's say the reasonable risk on that trade would have been something like £200, using that arbitrary example. But when the price comes down to something like 20 or 10, now the risk is £400. Double the risk. And emotionally, the trader's not ready to take that loss. Now what happens is that the stop loss is coming close to that level, and the trader adjusts it again and says, okay, I'm just going to give it a bit more room. It's going to come back. It's going to come back in my favor. And it doesn't. It absolutely falls through the floor. Big loss. That's the way that it happens. The trader didn't see what he couldn't see. Okay? So how does that apply to you? You put a stop loss in the market. Are you universally accepting the risk of that loss or that stop loss that you've placed in? No, not necessarily. It depends on the main mental framework that you're operating from. And the greatest framework that you can work from is that you're flexible. You understand the market can do anything at any time. And so if you truly believe that, it should be easier to get stopped out. Mentally, emotionally. But even when traders get stopped out, they fall into a very negative pattern of thinking, and then they start rationalizing that they did the right thing, they could have done this, they could have done that, where the reality is they had no control. You know, us retail traders, all that we're really doing is we're riding off the coattails of the big hedge funds and the institutions and just riding the wave. You get into a trade, you make money, you think that you did something special. No. There was a huge demand, as an example, that suddenly came into the market, which pushed the price in a certain direction. You didn't do anything special. It's the huge institutions that are pushing and moving prices. And they can move prices because they trade at a level and at volumes that they have significant impact on markets. So understanding that you have to be able to accept the risk that you're taking. And it's one of the most dangerous things. Think about that previous thing that I mentioned, that trading is like a minefield. Exactly. All it takes is one time out of, say, 100 or 1,000 trades for you to mess up, screw up. And then what ends up happening is you lose your whole account. This is the difficulty factor when it comes to trading. It doesn't matter if you do it 99 times right. All you need is one time for you to slip up, one time for you to not respect your stop loss, and you're cooked. Game over. Game over. Stop losses, boys and girls, ladies and gents, is an insurance to protect you against huger losses or bigger losses. Now, stop losses are only, we need to also explain this. Stop loss is not necessarily a guarantee that you're going to be exited at that price. It depends if there is a seller who can take the other side of your order, okay? And whether there are people at that level who are willing to buy from you. It depends if you're going long or you're going short, but the principle stays same. Long means you're buying the asset, short means you're selling the asset. So what does that mean? In fast-moving markets, there's not always liquidity at the level to get filled at the price that you want. So you, in our arbitrary example, if you have a stop loss at 30, you could get filled at 29, 28, 31, 32. And that is the term we use, which is called slippage in finance or in investments. You get slipped. You don't get the exact price that you're after. Yeah. Think about the times that there were those financial crashes. The problem that retail traders had, or the brokers had, is that prices moved so violently, so quickly. There wasn't enough liquidity in the market, and there was no one available at that level for them to sell their position. So in the case of the, as an example, the SMB crash in 2015, clients and brokers lost inordinate amounts of money in that crash. In a split second, accounts were decimated. So stop loss doesn't always mean that you're going to be exited at that price. And that's a risk that every single trader is taking. That's why you need to be clever, you need to do your homework, and you need to be careful when and what you're trading. So, for those of you who are starting off in trading, stop losses are essential. I remember when I started off, 11 years ago, one thing that I always did well was I honored my stop losses. Okay? It's very important, especially when you're starting out, because you have a finite amount of capital. You can't afford to lose too much money. If you lose all your money, you can't actually trade. And for many, many years, you are going to be losing. It's going to, as we said, take a lot of time for you to develop that level of skill that you can do it consistently and proficiently and be consistently profitable, as we spoke about in the last video. So this is a very, very important thing that you've got to bear in mind. If you have something like, I don't know, $20,000, $30,000 to your name and you lose 20,000 or 25,000, you're sunk. You don't have enough money to stay in the game, to learn long enough to learn how to do it properly. And that's why there is this thing called the 90-90-90 rule. 90% of retail investors lose 90% of their deposited margin in 90 days. Yeah. And it's like just churning. Brokers taking new clients, lose their accounts, and the whole cycle continues and continues. So when you're starting off, if especially you're new at this, even if you've got a couple of years of experience, remember, all it takes is one time for you to mess up and it can ruin the whole account. It's like a golf tournament. One shot is not going to make or break it, but one shot can make sure that the guy doesn't win the tournament. Yeah. It's like that. So I hope this gave you a lot of useful insights into stop losses. It's an essential aspect of trading effectively, and without stop losses, personally, I just think it's a big risk. Again, you have to make your own decisions, but stay safe. And I hope that this video was valuable. Cheers.